Howdy, Jacob here. Today we're looking at company 114 in our dividend yield screener, ticker symbol PINC. Let's look at some of the business or look at some of the financials here. So $2.7 billion market cap, $2.3 billion enterprise value. Looks like they have more cash on hand than debt. Look at their balance sheet and we see 90 million cash and cash equivalents, 102 million long-term debt. Very little debt. Short-term debt is about 316 million. Let's look at their. Oh yeah, they can definitely afford that. Okay, so very little debt on hand. That's great to see. It looks like actually this 350 million is probably that short-term debt being paid out. So they probably have $100 million in short and long-term debt, and they can easily afford that with a 5-year free cash flow of maybe 350 million. They pay out about 101 million aggregate for dividends. They can definitely afford that. Their use of free cash flow is towards acquisitions, and then dividend, and then hopefully these buybacks when their shares are super cheap. Let's look at a history of their dividend. They do not have a long history of dividends, so we can't really rely on that. But we can say that the payout is definitely reasonable. The company has little debt, and although they only have 90 million in cash on hand, their debt situation is definitely manageable, and they produce a great amount of free cash flow to where they can definitely afford this dividend. And so I think we can start making some assumptions here on the revenue side. We see 911 million in 2014 up to 1.3 billion. So not a whole lot of growth, but definitely a little bit. I might do 3% revenue growth, 14 on the P and price to free cash flow, saying that there might be some growth ahead of them after 7 years. But the business itself, just from a financial point, looks pretty cyclical. You have as high as 15, 32% return year over years, and then you have -16, -8. So it looks pretty interesting, but I think I'm comfortable with those assumptions. Margins, what is this averaging? Free cash flows almost consistently higher, so that's great to see. Positive free cash flow. It's not just from stock-based. Okay, stock-based compensation isn't too much of the excess free cash flow, so that's good to see. It looks like depreciation and amortization make up well above their capital expenditures, making their free cash flow well above net income. Maybe I'll do 22%, 16%, and then maybe no share changes. And as for the dividend, let's say that, because right now their payout is a 25%, maybe a little bit higher, high 20s. I mean, their ROIC wasn't crazy, so it's not like they can reinvest at super fantastic rates of returns. But I think as long as they'd use a little bit of money for acquisitions, a little bit of share buybacks when it's super cheap. Again, they don't have a whole lot of debt, so right now they don't need to issue it or buy back too much debt. So I could easily see this company raise their dividend 3% a year over the next 7 years, which gets us to a price that would need to fall 27% before we get a 15% return. Given these assumptions, I think this is definitely a company I'd want to add to my list of companies to buy for a dividend yield screener. Obviously, again, everything you buy is based on price, and so every situation is different. If all you care about is dividend, you may not care about price appreciation. Then your situation is different than mine, which is different than everyone else's. But a current 3.7% dividend yield, I think we get more comfortable as it falls down. The dividend yield goes up. The possibility for price appreciation on the stock price goes up. And right now, I'm just waiting until it gets to a more attractive price before I do more research. But definitely a company I would think to add to a dividend yield list, or possible companies to add to your dividend yield list to invest in, given that the payout's very low, low debt. Looks like they have reasonable growth ahead of them, reasonable possibility for growth ahead of them. Obviously, until you do further research, you don't know whether management's going to come through with that or not. But just looking at the numbers, it looks like a very reasonable company and definitely one I would add to list to possibly invest in for later when it maybe gets to a more attractive price, or you do a analysis on your own and maybe it's at that price right now. So thank you, and I hope you have a great rest of your day.